Those who are related in international trade business, practices and participants as the stakeholders by any means know of what the correspondent banking is. It is very vital for circulating the international transactions life cycles, especially the trade, finance and payments. But it has a lot risks in financial transactions from within and also from the other stakeholders if not passed through the transactions in a very careful and compliant manner. FATF Recommendation 13 therefore covers how correspondent banking should be kept under compliance blanket, especially for anti-money laundering and terrorist financing transaction-related threats. Welcome back. Today, we are diving deep into a crucial piece of the global fight against financial crime, Recommendation 13 of the Financial Action Task Force, or FATF. This one is all about correspondent banking, and it's a cornerstone of how banks around the world work together safely. Imagine a small bank in country A wants to offer its customers international services, like sending money to someone in country B. But this small bank doesn't have a branch in country B, so it partners with a larger bank there, called a correspondent bank. The small bank opens an account with the correspondent bank, and through this account it can process transactions for its customers in that foreign country. It's like a bank for banks, enabling global finance to flow smoothly. This sounds great, right? It connects economies and people. But here is the catch. This relationship can be exploited by criminals for money laundering and terrorist financing. Why? Because the correspondent bank is essentially processing transactions for customers it has never met or vetted directly. It's relying on the smaller bank, the respondent bank, to have done its due diligence. If the respondent bank has weak anti-money laundering controls, it becomes a gateway for illicit funds to enter the global financial system. This is where FATF Recommendation 13 steps in. It sets out the specific due diligence measures that a correspondent bank must take before and during its relationship with a respondent bank. It's not just a handshake and a trust me deal. It's a detailed, risk-based process to protect the integrity of the financial system. So what are these measures? Let's break them down. First, the correspondent bank must gather enough information about the respondent institution to fully understand the nature of its business. This isn't just about knowing the bank's name and address. It's about understanding its ownership and management structure. Who are the people in charge? What's their reputation? The correspondent bank needs to dig into public records, news articles, and other sources to get a clear picture. For example, if a respondent bank is owned by a complex web of shell companies with hidden beneficial owners, that's a massive red flag. Second, the correspondent bank must assess the respondent bank's anti-money laundering and counter-terrorist financing controls. This is a critical step. Are their controls strong or weak? Are they even up to international standards? The correspondent bank might ask for copies of the respondent's AML policies, look at reports from its regulators, and even check the FATF's own evaluations of the country where the respondent bank is located. For instance, if the respondent is in a jurisdiction known for high levels of corruption or weak regulation, the correspondent bank needs to apply much higher scrutiny. Third, the approval process for establishing new correspondent relationships must be escalated. This isn't a decision for a junior officer. It must be approved by senior management. This ensures that the risks are properly understood and accepted at a high level within the bank. Having senior management sign off adds a layer of accountability and seriousness to the entire process. Fourth, both banks must clearly document their respective responsibilities. Who is responsible for what? This should be written down and agreed upon. For example, the agreement should specify that the respondent bank must provide customer identification information upon request. and that it has performed its own proper due diligence on the customers using the correspondent services. This clarity prevents misunderstandings and creates a clear audit trail. And finally, let's talk about payable through accounts. This is a specific high-risk service where the respondent bank's customers are given direct access to the correspondent account, essentially allowing them to conduct transactions as if they were direct customers of the correspondent bank. Think of it like giving your friend a blank check from your own checkbook. The risk here is huge because the correspondent bank has zero visibility or control over who these individuals are. Because of this heightened risk, Recommendation 13 is very strict on this. It says that the correspondent bank must be satisfied that the respondent bank has performed full customer due diligence on these customers, the same level of due diligence the correspondent bank would perform on its own direct customers. And critically, the correspondent bank must be able to get that customer identification data upon request. If the respondent bank can't or won't provide this, the relationship shouldn't happen. Let's look at a real-world scenario to see how this works. Imagine a large US bank, let's call it Global Bank, is considering a correspondent relationship with a smaller bank in Eastern Europe, which we'll call Regional Bank. First, Global Bank's compliance team starts digging. They find out who owns Regional Bank, who sits on its board, and check for any negative news. Let's say they find that one of the major shareholders has been previously investigated for financial misconduct. That's a red flag. Next, they evaluate Regional Bank's AML program. They ask for policy documents and find that their customer verification processes are outdated and don't meet current FATF standards. Another red flag. They also see that Regional Bank's home country was recently flagged by FATF for deficiencies in its national AML framework. A third, very big red flag. Given these risks, the compliance team writes a detailed report. The proposal to partner with Regional Bank goes all the way up to a senior vice president at Global Bank. After reviewing the red flags, the senior vice president decides the risk is too high. The potential for money laundering is significant, and the reputational damage to Global Bank could be catastrophic if something went wrong, so they decline the relationship. This is Recommendation 13 in action. It's a shield protecting the correspondent bank and the wider financial system from being contaminated by dirty money. Now, what about the references and related guidance? The most important document is, of course, the FATF recommendations themselves, but there is also an interpretive note to Recommendation 13 which provides more detailed guidance on how to implement these measures. Additionally, bodies like the Wolfsburg Group, an association of 13 global banks, publish detailed guidance on correspondent banking due diligence. Their publications are considered industry best practice and provide practical, in-depth advice on how to manage these risks effectively. For instance, the Wolfsburg Correspondent Banking Due Diligence Questionnaire, or CDDQ, is a standardized tool used by many banks to gather the necessary information from their respondents. So, to wrap it all up, Recommendation 13 is not just bureaucratic red tape. It's a vital defense mechanism. By forcing banks to know who they're doing business with, to assess their controls, to get senior management approval, and to clearly define responsibilities, it makes it much harder for criminals to exploit the correspondent banking system. It ensures that the channels of global finance remain secure and trusted. Without these controls, the international financial system would be far more vulnerable to abuse. It's all about maintaining a chain of trust, where each link is strong and verified. The moment one bank fails to do its job, the entire chain is at risk. That's why this recommendation is so fundamental to everything the FATF stands for. Thanks for tuning in today. I hope this breakdown of FATF Recommendation 13 was helpful and gave you a clearer understanding of how we protect our financial world. If you found this video valuable, please hit that like button, subscribe for more content on financial crime compliance, and drop any questions you have in the comments below. See you in the next video. Until then, keep attached to your improvement in the respective disciplines and grow. Thank you.